Here are 4 high quality companies to add in this raging bull market. So for reference, this is my entire portfolio. My portfolio has been doing well recently. So Google and ASML, they're nearing all-time highs again. I'll be covering this one later on. So in today's video, I'll be covering the first portion, which is your high quality companies that are worth looking at right now. So before we start, I would like to touch on pricing power first. So pricing power is a lot more important than volume growth. Pricing power is especially important for your low margin businesses because let's say a company is able to increase prices by 1%, and let's say if they're able to maintain their cost the same, what happens is that 1% will flow straight down to the bottom line, which is pure profit for the company. And when that happens, what this means is that your net income will grow a lot faster than the revenue growth of the company. Besides that, what you can do is to try and use this formula here. So the formula is your increase in net income is equal to your price increase divided by your net income margin. So take for example, if let's say a company has 10% net income margin, if you're able to increase the prices by 1%, what that leads to is a 10% increase in the net income for the company. So a potential catalyst style investment that you can look into is to search for companies with low margin that is tapping into its pricing power, and when they're able to expand that pricing power, it will lead to a lot more growth in terms of the net income for the company. So find companies that are able to increase prices without increasing cost. When that happens, this is called operating leverage, especially when a company has majority of its costs tied to fixed costs. So in this video, I'll be covering some of the companies that exhibit this characteristic, and this is why your pricing power is a lot more important than your volume growth. So the first company that I'm covering is Zoetis. So Zoetis year to date is now around 3%. It's a quality business. So for Zoetis, what they do is they sell the lift and then they maintain the lifts as well. So they have an installed base of around 2.4 million lifts globally. So currently now the profit distribution is as such. They have around 13% of their profits coming in from new equipment. What that means is your new lifts, your new build-outs, your new buildings. And 87% of the profits right now is actually tied to your services portion. So that portion is highly recurring revenues coming into the company every single year, and they're able to increase the prices for that as well above the levels of inflation. So for Zoetis, the company actually lowered the guidance, which was why the stock dropped by quite a fair bit this year. So the company reduced their outlook from around 1.6 billion of free cash flow to between 1.4 billion and 1.5 billion. They also reduced their constant currency adjusted operating profit from 105 to 135 million to 50 to 90 million. So that was quite a substantial decrease in terms of their outlook this year. And this is mainly because of their China housing prices. So Zoetis 4 is entirely tied to your Chinese portion. So if you're to look at the data over here, this is what the management provided. So total Zoetis is negative 1% in terms of your new equipment. Ex-China is up around 11%. Your new equipment backlog is also down around 3%, and ex-China it's up around 8%. So China now makes up around 17% of the total revenue for the company, and it is sort of like an overhang for the company right now because your Chinese housing market is quite weak right now. But if you're to do some napkin numbers here, so their services revenue make up around 80%, which is highly recurring. The company has built-in pricing power as well, so they're able to increase their prices by 1% every single year, which will lead to a 4.5% increase in net income for Zoetis. If you're to add volume growth, that's around 10% for the company already. So to get around a 10% return from a company like Zoetis is entirely possible with minimal downside risk as well, which is why this company has been on my watch list for a very long time, and I'm actually looking into this company even further, especially after the drop that it just had. So for Zoetis, it's sort of like a macro bet as well, because your Chinese housing market is weak right now and it looks like it is recovering. It could be a macro bet, it could be a macro play on your China housing market recovering. And when that portion recovers, we could see Zoetis going back to growth of around 8 to 10% easily, which is what it is achieving now outside of China. So for Zoetis valuation today, it is currently trading at one of its lower valuation points as well. So the company is trading at a 23 times of earnings, which is historically on the low side. I think for a quality company like this, it definitely deserves a higher multiple. I mean, you have companies like AutoZone trading at 30 times of earnings. Of course, this is all relative, but for Zoetis, it is a high quality business that definitely deserves a premium. Next company that I'll be covering is Elevance Health. So Elevance Health is down around 16% year to date, currently trading at a 9 times of earnings. So for Elevance Health, they have a few business models under them, mainly two. So the first portion is your insurance portion, which is your Anthem Health as well as your WellPoint. The second portion is their PBM portion, which is their Carelon business. So for Elevance Health, it is sort of like United Health, a smaller version of it. It is trying to build out its PBM portion as well, and that is a possible thesis for Elevance Health. So for Elevance Health, the Carelon portion is growing at 15% almost every single year. They're accelerating in terms of revenue, especially with all the acquisition that it has been putting out for this Carelon portion. So profitability is not optimized yet, and if the company is able to turn this portion into a significant portion of the entire business, this company could become a juggernaut like United Health as well. Of course, this is all if, buts, and maybes. Their CEO, which is Gail, was previously under United Health as well, so she definitely knows the ins and outs of the entire healthcare insurance portion in the US. So this company is a decent quality one that is lagging behind your other insurance companies, has been up quite a fair bit over the past month. Next company that I'll be covering is Adobe. So Adobe is currently down around 20% year to date. It is currently trading at a 21 times of earnings. So for Adobe, here are some of the concerns for the company. So the main concern is tied to your Gen AI, your Photo Gen AI, which is creating images and reducing the need for your Adobe products. So about 20% of their revenue actually comes directly from your photo editing software. And this portion is the one that is most tied to your AI risk. So if you were to discount away the 20%, if you were to halve it, that means that Adobe will lose around 10% of its revenue, which leads to around 10% loss in terms of profits as well. So that will put the company at around 24 times of earnings. For 24 times of earnings, I think the company is still reasonable. Although it is not extremely cheap, the downside is definitely still there at this price. But for Adobe, it's looking attractive today. If you were to look at the fundamentals as well, the company is amazing all around. So revenue growth of 10% every single year. Profit margin of 30% is comparable to companies like Microsoft, like other software companies as well. And for Adobe, it is a fundamentally sound business, and the stock price is deviating away from its fundamentals. The valuation today is at its historical low as well. So over the past 10 years, Adobe has never traded at below a 20 times of earnings, and it is currently trading at around a 20 times earnings as well. So for Adobe, I think the company is decently priced today. I think the company is priced for minimal growth, and once it creeps into the territory of pricing in zero growth, that could be an interesting point for you to add into this company. Last company that I'll be covering is Airbnb. So Airbnb year to date is now around 8%, currently trading at a 29 times of earnings. So for Airbnb, it is arguably a better company than Booking because it is less reliant on your Google ads. It has less risk. It is the first mover in your home accommodation as well. But for Airbnb, the reason why the company is not a better investment than Booking is simply because Booking's management team is a lot more shareholder friendly as compared to Airbnb. So for Airbnb, as well as all your other OTA companies, your travel demand is projected to grow all the way until 2053. So we will likely see more increase in terms of international passengers, which is also a bullish point for Airbnb, especially since the company is more reliant on international passengers. For Booking, it is more reliant on your domestic passengers, especially in Europe. So for Airbnb, the company is also trying to turn it into an everything app. So the company is trying to venture into all these other portions. They're trying to leverage on their current platform and their current user base to push into all these different other avenues as well. I think this could turn out to be a success for Airbnb. We've seen what Uber has done with their ride sharing to currently now in food and other segments as well. So Airbnb is doing something similar, and with the sheer amount of users on the app today, Airbnb will definitely be able to turn this into something that is profitable. It could be a story for the company to extend its runway of growth. So for Airbnb, the company is innovative with a decent management team, with minimal capex, and the company is actively extending their pathway of growth. So the company is a decent one to look at right now, and Chuck Akre Fund clearly thinks the same as well. They own around a 4% stake in this company, and this company looks decently priced, and this company is a decent quality one that is having a drawdown right now. That could be interesting for you to look at. Last portion, I'll be covering some questions left in the comments. So the first one, it says, hey Guan, do you mind sharing your returns for the year and your biggest winners versus your biggest losers? So my biggest losers by far was United Health at one point. I was down around 40% on my initial position. My first initial entry on United Health was closer to around $380 a share. I was adding all the way down until around $280 a share. I believe my last add was at around $250 a share. And it's currently back up to around 10% in the green again. So that was my biggest loser this year. As for my biggest win, it is still Google. Google is up around 50% since I started adding to the position. So that company is a decent one and a company that I overweighted in my portfolio, which has led to outsized returns. As for my portfolio returns, I have two portfolios here. One of it is the Webull portfolio, which is the one on the left hand side. The Webull portfolio is around 70% cash. I hold my cash position in there. So it's around 25% return excluding the cash. As for my IBKR portfolio, which is my main portfolio, it is currently now at around 25% return year to date. It's not doing too bad, especially after the surge in stock price for Google. Next question it says, thank you for your analysis. What are your thoughts on Zoetis? Would appreciate your analysis. So it is less prone to regulation as compared to companies like Novo Nordisk. But for Zoetis, I think it is a company that is a bit too complex. The company has many different drugs, and unless you know the ins and outs of your pharmaceutical companies, I think it's a company that I would avoid, although it looks like a compounding machine with its great fundamentals. I hope you guys have found this one useful and invest safe.